All right. Good morning, everyone. Welcome to the EASSI webinar on financing EASSI projects. Thank you for joining us today. We will get started. So, this is our agenda for today. So we'll do a quick round of introductions. We are joined here today with Sam of CDFI Friendly South Bend and Andre of IFF. They're key partners of the EASSI program. They have experience and expertise in financing. Sam will get us started with some financing tips, followed by Andre. And then I also have some tips from the Office of Sustainability that I'd like to share that are related to the financing of EASSI projects. And then we'll conclude with some Q&A and announcements. So without further ado, I'm going to hand it off to Sam and Andre.
Good morning, folks. I am Andre Gibson. I am our Director of Lending for IFF, serving the states of Indiana and Kentucky. I have been on board with IFF now for 2.5 years and enjoying every single minute of it and love doing things like this to help support the community. I am a banker by trade. Come from the traditional banking institutions. I kind of call them the big boy banks, your BMO Harris's, your PNC's of the world. Started out there on the retail side and went into the commercial lending side where I found out that it was just a better fit for me. And then was very fortunate enough about 7 years ago to stumble into the CDFI world. And CDFIs, are organizations that you can think of them as a community lender, and that's just the way that we think of ourselves, as a community lender. And we try to do our best to support to support nonprofits in the communities in which they serve. Just a little bit about IFF. For those of you who may not know, we are a Chicago-based CDFI. Started out about 35 years ago with a small pool of funds that our original executive director was trying to figure out ways in which to support nonprofits. And knowing that most nonprofits did not get a true fair shake from traditional banking as it relates to lending. So we decided that way back when that we would try to do whatever we could to provide access to capital for nonprofit organizations. And with that small pool of funds, we've grown that now over the last 35 years. I believe we started out with $2 million. I may need to be corrected on that particular start number, but I am really sure about what we've done over the last 35 years. We have deployed over $1.3 billion, with a B, billion dollars in funds for nonprofit organizations. We are now operating out of 9 states. We don't have an office in all of those 9 states, but kind of like myself, I am officed here in Indiana, but I service Kentucky as well. We've got a couple of offices that operate in such a manner, but that is mainly what we do. That is part of our main core business. We also have a second part of that core business, which is our real estate solutions. And I have a colleague, Donna Sink, on the line who just gave us the thumbs up there. So we do those kinds of things. That is our consulting arm. And we work hand in hand on projects like this to kind of help people to kind of get an understanding of what their real estate needs may be, and then how that may transfer over into a loan product. So that's a little bit about who we are, what we do. We do several other things. We don't have time to go into all of those at this particular point, but just wanted to give you a quick overview. And I will now turn it over to Sam, and I'll talk to you guys a little bit later.
Awesome. Thank you, Alex, and thank you, Andre, for tossing that over to me now. So I'm with CDFI Friendly South Bend. I think most of the people, luckily, I think I've met that are on this call, so that's great. I worked for 8 years at La Casa de Amistad, previous to that at Ivy Tech in South Bend and IUSB. And so I've been in South Bend for a long time and worked in the nonprofit world for a long time. Andre gave a great example of what CDFIs do, and they tend to finance projects that traditional banks and credit unions maybe don't. And one of those is nonprofits, which is what we're here to talk about. And IFF has just such a great reputation of helping finance profits for nonprofit organizations. It's the focus of what they do. And so during my time at La Casa, when I've seen all the challenges around finance for whether that's minority women-owned businesses, whether that's for affordable housing developments, all the different places and spaces that weren't receiving the financing that they needed. And so that's part of why I wanted to get involved in the CDFI friendly approach. And I'm going to cover the first couple things here for us as we roll along and talk about what we do. One thing I'll be clear when I present, I'm not going to read, for the most part, I'm not going to read my slides to you. And we're going to consider this a very nuts and bolts kind of presentation on my next slide here. And so when I'm going to run through some things that for the most part are for you to follow up on. If you haven't done it, you can talk to me. I can get you resources on how you can get these items done. But there's a list of things for nonprofits that you need to do. The first is to just think about finance. I can generally guarantee that every single nonprofit organization, your board is going to tell you doing debt, going into debt, having some type of debt as an organization is a terrible thing and we shouldn't do it. We need to balance every year. And so one of the things I tell organizations, I probably should have made this its own slide, but right, you don't need to fear credit. You need to respect credit, but you don't need to fear it and fear debt, right? And so I definitely want to talk about a couple things. So we'll talk about a few things. One, your organization should have a DUNS number. Most of you are established nonprofits and you should have DUNS and or like a SAM.gov number. If you don't have those things and you're like, I don't know what Sam's talking about, either ask somebody up your finance food chain at your organization. If you're the top of the food chain at your organization, I see some of you are executive directors on here, and you don't know about that, you need to find out. The other thing from a nuts and bolts standpoint, and we'll run through specifics on each of these, is having a business credit card. I know that once again, business credit card, it can sound scarier versus like, well, we have a debit card and it does what we need it to do. We're going to talk a little bit about, and I'll give you some examples of why it can be a really good thing to have a business credit card, not just a card with a logo on it that means you can swipe at places. The other one is looking at, especially if you're looking to grow as an organization, looking to doing bigger projects, is thinking about some type of installment credit. And I'm going to talk about how we help build La Casa's credit rating through installment credit through an auto loan. And then the last one that I actually encourage all organizations to have basically all the time is some type of a line of credit as an organization. You never know when you're going to have an emergency, equipment's going to break down, something that you've got to address right away, and your organization having some type of line of credit that's larger than what you could normally do on a credit card, generally lower interest too, but that you've got it just in case. And I'm going to talk about each of those things. So next slide, please. So does anybody know who can answer for me here? You either put it in chat, or I don't know if Alex lets you unmute yourselves, but who knows what a DUNS number is? I'm not going to move on until somebody answers it. So even if one of you is Googling it really quick, I'm fine with that.
Got it. I know the answer.
Go, Angelica.
Because I was Googling it because I want to say something else about this. So it stands for Data Universal Numbering System.
Oh, that's a good Google, but that's not it.
Oh, that's okay. Well, are you sure?
There are multiple.
Dun and Bradstreet that assigned a unique numeric identifier referred to as a number to use a single business entity.
Very good. So, right. So the street term is always Dun and Bradstreet, right? So, and I don't know where that came from and who Dun is and Bradstreet. I'm assuming we can like look them up. But that's what it stands for. So good job, Angelica.
Wait, can I interject
yes.
a tangent to your whole point that just because I'm currently going through this, I've known our DUNS number for years now. I have it, where I know when I need it. And recently one of the government grants that we get told me that I needed a UEI. It's a unique employer identification number or indicator maybe. And I'm going through a whole process, and they told me that your DUNS number you can't use it anymore, and you got to get a UEI.
So that should be, and Andre, you might correct me if I'm wrong, right? But so that's the SAM.gov number.
Yeah.
So some people call it your SAM number. And so there's certain places where now you have to use a SAM number. There's other places where the DUNS number is still good, but they're different. And the SAM transition just, I guess, legally started this last year. I mean, it officially started a bit ago. Like in Indiana, they've been using it for a long time for different like government grants and IDOE things. But yeah, so there is a transition there. So you should have, Andre's shaking his hand, so you should have both, but you do need to get a number from sam.gov.
You should have both. True.
Yep.
I'm in that right now. Yep.
Excellent. So that's what that stands for, and we can roll to my next slide. Thank you, Angelica, for playing along. So you beat me on my next slide here, right? So that was you might also be required to have a SAM, which is your UEID through sam.gov. All right, next slide. So the next thing on my list was talking about a business credit card. And so I want to talk about a couple of the benefits of a business credit card. One, most often business cards, credit cards in general, but business credit cards as well, come with additional fraud protection, which can be very helpful, especially if you've got a program with multiple, people using cards and having cards. So that's one of the really great reasons to have it. The other great reason to have a business credit card is if you're earning rewards, right? If your organization's buying certain things from certain vendors over and over again, is a great way for you to earn organizational rewards. It also helps you connect with a bank. So I don't know how many of you are doing this. And so I'll refer a lot to my time with La Casa de Amistad. For us, right, we took out a credit card with a different bank than where we banked, and AKA where we had our deposits, right? And so it was a way for us to have a relationship with different banks. And for all of you that are doing grant writing, you know that oftentimes when you're asking banks for money, they ask, do you have an account with us? I serve on a lot of nonprofit boards. I have some nonprofits that literally have a bank account at every single bank in town, just so that they can have a bank account so they can check that box on an application. This is your way to have a relationship with another financial institution without having to open up another deposit account. And so I'll use names, right? But La Casa took out a First Source Bank credit card so that we could build a relationship with First Source Bank when we decided to take out our first business credit card. And then the other, right, you're creating history. We would pay it off every single month. The other thing that I liked about it versus some of the debit accounts is we were able to set up cards by name easier, and it helped us track expenses, and we did that. So it can be really helpful. I'll always cover some risks with everything, right? There's issues with employee fraud, right? Who's got cards, how they're using them. Oftentimes business cards will get linked to people's personal credit, which sometimes employees don't like, which is okay. But then if they're partially going to be held liable for fraud, right? If they do it. So that's one part. Always watch for your interest expense, right? So we would pay it off every single month. So we never had to worry with that. But do watch your annual fees, right? The cards with the biggest benefits generally have the biggest annual fees. We were always pretty good, at always asking or like, hey, we're a poor nonprofit, we don't have to pay the fee. And we generally would, if we looked at credit, we'd be able to get out of paying fees and things like that. So those are some of the risks. Also, as we keep rolling through, go to my next slide. As we keep rolling through, feel free to either raise a hand or we'll have plenty of some question and answer period at the end. I'm going to give more of a detailed example of how installment credit can be helpful, but right. So installment credit is anything that you finance, right? So that's something like, when you think about buying an appliance and you finance it with a place, you're buying some dishwashers or fridges or some other equipment, the same, oftentimes the easiest way to think about installment credit are things like a car loan. And for those of you that manage your personal credit at all, right, you see how those things show up differently on your personal credit versus a credit card. And so that's why installment credit can be a great way for your organization to build some track record, also build, like another financial kind of mechanism to understand how this works, also how it shows up on your audit. So that was the first time La Casa took out a loan to buy a vehicle. It's the first time we had debt in many, many years on our audit statement. And so it's a great way to kind of talk about debt with others. Right. So the risk is, right, long-term expenses. If you start, be careful, right? If you take out and you buy something you can't afford, right, you're going to get yourself in trouble that way. I wouldn't say it's a risk, but there's always a cost of interest. And that's part of what we're going to talk a little bit about today, right? Loans have a cost. They're different than grants, right? It's not free money. You got to pay it back. But we're going to talk about how that cost of interest, I always call it opportunity cost, right? Is the opportunity you're losing by not making that expense. I'm going to do an example for all of you in a second. Next. Is my story next? I forget, I'm not controlling my slides here. So here's line of credit. So this is a really, and there's a couple credit unions. There's some banks in town that do these. And so, you know, I don't want to promote any specific place. I'm also always clear, like through CDFI Friendly South Bend, we make no commission off any loan closings, any of these deals, you know, so we fundraised funding to be able to do what we're doing to provide advice and support to small business and nonprofit organizations without, you know, I'm not a salesperson. So a line of credit is basically like a credit card, except, you know, it's set up through a bank. For any of you that maybe have ever done like a HELOC, like a home equity line of credit personally, it's the same kind of thing. You would apply for, you know, $30, $40, $50,000 as a line of credit, generally potentially for something, right? So for building expenses, building repair or something, and it's an open line of credit. You only pay interest like a credit card for what you're using. Right. So we ended up buying a $10,000 thing on my $30,000 line of credit. I'm only paying interest on that $10,000 that I'm carrying on it as long as I'm carrying on it. Generally, lines of credit are going to have a lower interest rate than a credit card because they're a little less flexible. There's less risk than a credit card here, right? Because there isn't, you know, none of your employees can just run out somewhere and, you know, buy a bunch of things on your line of credit. Once again, it can help build your credit. As long as you're utilizing it a little bit and paying that off. Once again, the risks here, it's always cost of interest, but I'm going to talk about the opportunity cost around what it means to have that. And I'll use an example here that's something La Casa did during our expansion project. And for those that maybe aren't familiar, right, La Casa just moved and we went to a new site. When we did our cash flow analysis over time, we saw some points that when pledges would be coming in and when some of our expenses would come that we were worried about our cash flow being low. So we actually took out a line of credit. We actually $100,000 line of credit secured by our former building that was already paid off to have in case we ever got really low on cash and I needed to pay contractors, we could pay them from that and not have to like stop work for a month and a half while we waited for a check to come in or something like that. And so I wanted to say, if I remember correctly, that was like 5.5% interest. It was a pretty good rate. And it would have meant we wouldn't have had to stop our project temporarily. So that's what some of the great reasons for line of credit. And we building our credit by having credit cards, by having a car loan allowed us to, when we started the process to apply for a line of credit, right, we had established, you know, that we were financially responsible. Next slide. So I also know from the finance world, especially for those of you that are CEOs, right? So I was an executive director of a small nonprofit, and we already have to know way more things than we ever wanted to know about things we never wanted to know about. And so I get you don't want to know about everything like LOC and capital ratio and equity and Oreo and, you know, amortization schedules. It took me a while just to say amortization schedule right without sounding like an idiot. And so now I sound really smart when I say it, which is kind of nice. So I like to say amortization a lot. And so I get that it's scary, and that's why you've got friends in the industry, right? Whether that's, you know, through a United Way circle, talking to other nonprofits that have done similar work, talking to me, you know, talking to an organization like IFF and Andre that aren't here to make money selling loans, right? They're trying to help you achieve your goals as a nonprofit. So let's go to my next. And I'm going to tell a really quick story. Don't go to my next slide yet or my next transition. But so I'm going to tell you a tale of two vans, and I'll go quick because I'm taking a little longer than I'd planned. But so when I got hired at La Casa, we had two vans, this white old Econoline. It was like a 1991. It only had 4 seats in it. We used it for our food pantry. Whenever you drove it for more than 10 minutes, you got out of the van smelling like gas. I mean, it was a hazard. Then we had this 1996 Dodge Ram Majestic conversion. That thing was sexy. And that's what we drove the kids around in. And so I tell one of my stories of the first fundraising gift I ever had at La Casa was I'd driven both vans in my first month on the job. And then one of the days I was actually helping to do a food pantry run really quick. And I run out to the van and it doesn't start. And I run inside like, oh, the van's not starting. I'm going to have to take the purple van to the food pantry. Where are the keys? And our building manager goes, oh, no, it's fine. The battery's in the other van. I was like, what? They're like, yeah, we only have one battery. So we had 2 vans, 1 battery, and that's how we kind of operate as an organization. So model of inefficiency, but I would be willing to bet so many nonprofit organizations in this town do the same thing. That very afternoon, I posted on Facebook, we needed a battery, and my friend Lali Maldonado over at Notre Dame came that afternoon and dropped off a battery to us. So we had then 2 batteries, 2 vans. But the real story, and actually you can do my next photo of that purple van, why we needed to get rid of these vehicles. So the purple van was like plush seats. I mean, it had like the shades in it. It was about as creepy as it gets, and we drove kids around in that van. So I knew we had to get rid of these 2 vans. So next slide. And don't mock those vans. They've been gone for a while now. So La Casa saved up money. We wanted a van. We had $15,000. Our board wanted no debt. So our board said we should just buy a little minivan, pay $14,000 on it. It'll be fine. I wanted to finance a larger 12-passenger van. Obviously, you can see from the photo there what we ended up doing. Next slide. We financed the larger 12-passenger van. So I'm going to give you the numbers on it and how it made sense for us, right? So we purchased the van for $27,000. We took of the $15,000 we had saved, we put $5,000 of that down on the van. Our monthly payment on that van was $380 a month, right? So then we put we kept our $10,000 in savings, reserves, right? So we've got cash to sit on. We then paid the van off in 3 years. Interestingly, right, when a donor saw in our annual report the next year that we had debt, they're like, why do you guys have debt? And they asked me questions about it. I said, oh, well, you know, we financed the van. They're like, oh, well, I'm going to give you more money then if you got debt. And I was like, oh, okay, good. It's awesome. So I planned to take it out because we needed it. But we actually got an extra donation because we had debt in our program. I can't read my slide because the little bar is in the way here, and I can't move it. But the other one, which I would have done as a little guess, I think my slide got mixed up here. Every single year we had to rent vans in the past. So we had, we'd rent a minivan and we had our other minivan. And so because we only had one vehicle, we were saving between $1,600 to $2,000 a year and not having to rent when we would needed 2 minivans for activities. And so the financing here was a win because overall in interest on the van, we only paid $2,000 in interest, right? So I think next slide. So the cost to us to finance the vehicle above and beyond, right, we paid more than the $15,000, but our cost and interest to be able to have the vehicle was $2,000. But I was saving myself between $1,600 to $2,000 per year by having the bigger vehicle that got done what we needed. And this vehicle worked for the food pantry well, because we could take the seats out, load it full of food, put the seats back in, load it full of kids. It was an amazing investment as an organization. And this is what it took to help get our board, like walking them through these numbers, got them to agree for us to take out this loan so that we could, have the van that we wanted and we needed without having to put the organization in a financial bad shape. And so that's part of it. I think we go to my next slide. And so that's part of what I want to use as an example when we're talking about the EASSI project is, right, you've got an opportunity here to max out some either rebates, programs, match from the city. Don't miss out on it because of interest expense. And then from there, I'm going to hand it back over to Andre. And that's what IFF does, is help you achieve your outcomes as an organization through finance, to talk a little bit more about how IFF can help you finance your project.
Thank you, Sam. Great example there. That was awesome. Well, and as Sam was saying, is that, a lot of times your boards may think that debt is not good. And, the thing about what we try to do is, as a lender, we're trying to make sure that we're not putting you in a worse situation than what you would already be in. So we're going to try to dissect what you're looking to do and try to make sure that it's a good fit for you, that you can afford the debt, and it'll put you in a better situation than what you are now, kind of like Sam was just outlining for us. So I want to just get across that debt is not always bad. And sometimes it can help you to be able to continue with your programming a little bit faster than what you may normally be able to do. If you're waiting for a grant to come in, or if you're waiting for pledges to come in, that might set you back. It may set you back 3 months, 6 months, a year, whatever the case may be. And sometimes lending can help you get to your programming a little bit more quickly. So I don't want you to always think that lending is bad or that loans are bad. Let us help to kind of define that for you. And just trusting that we won't put you into anything that we don't feel like you would be able to really be able to stomach, because we are here to help nonprofits. As Sam was saying earlier, we're not here making commissions off loans and things of that nature. We were put in place to do just that, to help nonprofits. So a little bit about IFF and the way that we lend. Again, our lending practices are comparable to banks, traditional banks. And what I mean by that is that we have an application process. We, collect documents. We'd like to get some historical data on you. We would love to be able to get a budget from you, what you're going to look like next year. And then, if there's something that you are trying to get a loan for, how does that look in the coming years as well? So in that regard, we do operate much like a bank. We do have an approval process. Depending upon the size of the loans, we may have to go through a loan committee, just like I used to at the bank. And of course, we have a approval or a declination. We have commitment letters that go out. We have a closing process. So all of those things are the ways in which we do mimic a traditional bank. Where we start to differ from banks, I think a couple of key points here. Where we differ from the banks are our underwriting is a lot more conducive to nonprofit organizations. My thought when I was at the bank, I never even had an opportunity to work with nonprofit organizations because most traditional banks just don't understand the financing. They don't understand the financial statements of nonprofits. They don't understand the grant dollars that are coming in or the pledge dollars. So they really don't have an underwriting mechanism that's conducive to working with nonprofit organizations. So that's where I feel first and foremost, we are a better fit. We understand it. That's really all we do. I'm going to say about 95% of the loans in which we deploy funds are nonprofit organizations. And again, remember that number, $1.3 billion. That was, again, 95% of those dollars were going out to nonprofits. So we know how to work with your organizations. The second thing I'll talk about is, again, just the underwriting in and of itself. We are community-based lenders, mission-based lenders. We are looking for kind of the story behind the numbers. We are looking for how you are helping support your community. Who are you supporting within the community? So we always kind of start with that premise in and of itself. Are jobs being added? Are we helping disadvantaged communities? Are we helping disadvantaged people? Those are the kinds of things that start our conversations. Again, much different from traditional banking. Traditional banking, we're getting right into the numbers. Can they afford the debt? Yes or no? That's kind of the way that conversation goes. Now, I don't want to, make it sound like, this paint this big rosy picture. Of course, we are also looking to see how you can pay back debt. Obviously, if we lend money, we'd love to be able to get paid back as well. But we are looking at much more the story behind the numbers to be able to see how we can really lean in. With us with us not being a traditional lender, we have a lot more parameters and less restriction on how we can lend, who we can lend to, things of that nature. And actually, Alex, if you can back up one, I'll go into that one as well, just to kind of give a little bit of background of us. So I just wanted to kind of set that differentiation between us and traditional banks. Our interest rates right now, we're pretty darn comparable to banks right now. We're at 5.875 interest rates. We can amortize a loan over 15 years. And I'll get back to that in a little bit here, but our typical loans, we amortize over 15 years. Did I get that right, Sam? Do I sound smart too when I say it? So we do amortize over 15 years. Now, you may think, well, gosh, that's a long time. We don't want to have debt on our books for 15 years. Well, no problem there. There is no prepayment penalty if you did pay back the loan in a shorter time. But if we amortize over 15 years, that will help to free up working capital for you, or that will help to free up cash flow, if you will, for you on a monthly basis. Our lending parameters, as far as dollar amount, we can lend as little as $10,000 on any particular project, up to $6 million on any one specific project. And I know that is a huge range, but that just kind of shows you the depth and width in which we're willing to go with these loans. Next slide, please. Again, the main bullet point here is the no prepayment penalty. Again, if you wanted to do a loan for only 3 years, that is no problem. Sometimes we do what we call a bridge loan. A bridge loan would be, let's say that you've got a pledge that's coming in 18 months, but you don't want to disrupt your programming and wait those 18 months. We have a bridge loan product that says, hey, we'll go ahead and front you that money so you can continue with your great programming today. And then when those funds come in 18 months or 24 months or whenever it may be, then we're able to look back and pay off that loan. So we can do bridge financing as well. And I always want to make that to be known, especially in situations like this, because sometimes you do know monies are coming, but you really can't wait, and you don't want to stop programming, or you don't want to wait on your programming. So keep that in mind as well. Again, I talked a little bit about our application. I will say that we do have a detailed application. It is a 16-page application, and that I know that sounds horrible, but most of those 16 pages probably will not apply to you. There are some specific, there's some industry specific sections on that application, but we do ask for as much information as you can give us about your organization. Along with our application, we do ask for a checklist of items that is kind of loan and organization specific. So once you do decide that you would like to apply for anything with us, we would then ask for some specific information related directly to your organization. Some of the information that we do ask for, we ask for 2 years of audits. If your organization is not big enough to have audits done, or if you just have decided not to have audits done, we can use 2 years of 990s. That's how we get your historical data. We'd love to get your corporate documentation, your bylaws, any documentation that you may have on your board. That's another area in which we differ tremendously from banks. We are very interested in your board. We are very interested to know how active they are, who's on the board, how do they contribute, how often do you meet, how engaged are they, do you have any areas of expertise on your board. We really try to look into that and see how your board is supporting your organization, and that's really key to us. Excuse me. Our loan amounts, we have a couple different cutoff points for our loan amounts. Again, as I said, we start at $10,000. But if you're having a loan request, I'll give you 2 benchmarks. If there's a loan request of $350,000 or less, $350,000 or less, we have an abbreviated process. And what I mean by that is we don't have to go to the full-blown loan committee, which is a 7-person committee. We do a full presentation, they vote. So that's kind of its own process. 300,000 or 350 and less, we just do our loan write-up, we do the underwriting, and we just send it to our chief credit officer and our chief lending officer just for them to review. It's a lot more streamlined process. We try to get up and down on those loans literally in 48 to 72 hours. We're really trying to make sure that process is shortened and abbreviated so we can get on with the next organizations. If we are looking at loans over $3 million, and I'm not sure if that applies to any of this with the EASSI program, but if it's a $3 million loan, we've got several processes that we have to go through to get the loan funded. It's still a little less cumbersome than traditional banks, but they're just a lot more steps. So if you do have a $3 million request or more, we can talk about that at a later time. Next slide, please. So kind of a real world example. And before I start into the real world example, just to kind of give you an idea of what we can lend on. For nonprofits, we can really kind of lend on anything. We can lend on vehicle loans, as Sam was talking about. We can lend to purchase a facility, to rehab a facility, to build out in a facility, to acquire land. I'm going to say working capital, but I'm going to say that with a little bit of a caveat, because working capital, we've just started doing just a little less than a year ago. We've not really refined that process yet, but we can look at that. The one thing that we cannot do that I know Sam was really high on would be like a line of credit. Unfortunately, at this point, we do not offer a line of credit. But I agree with Sam wholeheartedly that if you can get a line of credit through a traditional lending institution, or maybe even another type of CDFI, I would highly suggest that you do so. So just wanted to kind of give you a little bit of an idea of what we can lend on and lend into. So this real world example, so we're looking at a loan of about $25,000, which may fit somewhat nicely into the EASSI program here. With our interest rates being what they are as of today, 5.875. We're going to say, let's say you want to do that for a 5-year term. We do have what we call estimated closing costs. They're never quite 1%, but usually they fall right around 1%. So our closing costs would be in there. So that monthly payment is going to be $482. Again, 5.875, 5-year term, a monthly payment of $482 on a monthly basis. So the total interest and fees paid on this, assuming you took this out for the full 5 years, you're looking at roughly around $3,900. That is with fees included, with fees and interest. Overall, you're looking at basically about $29,000 in payback for that dollar amount. Now, if you're looking at that and you're going, wow, $482 on a monthly basis, that could be a little steep for our organization. Remember, we can stretch that out to 15 years. If we were to do that, that monthly payment goes from $482 down to $209 a month. So then you say, well, $209, that sounds a heck of a lot better. I'll go ahead and do that. Well, we can do that. Again, we can amortize over 15 years. And let's say you have a pledge that comes in, or let's say you have a donor that comes in and says, you know what, hey, as Sam said, I see you guys are taking on debt. I'm going to, add a few extra dollars to my contribution to you. Then you want to pay that off. Again, keep in mind, no prepayment penalty. But what we've done is we've been able to save you a little bit upwards of $200+ on a monthly basis by stretching that out over a 15-year period. Again, that 482 goes down to 209 on a monthly basis. That way you're able to keep cash in your pocket, and again, making your organization a little bit more sustainable on a monthly basis. Next slide, please. And actually, I think I am done. I know we have some time for Q&A afterwards here, so I'll go ahead and turn it back over to Alex and be willing and able to answer questions as we move along. Thanks.
Thanks, Andre, and thanks, Sam. Just have a couple tips from the Office of Sustainability. More also kind of thinking about this through the EASSI program in terms of how you look at projects and finance projects. So another good tip to keep in mind as you're starting to think about what projects you want to pursue and how you want to finance them is to also think about available utility rebates and incentives that would provide additional savings to you, not only from the energy efficiency point of view and the matching grant provided through EASSI, but also those rebates and incentives that the local utilities here provide. Indiana, Michigan Power, and NIPSCO, they have a range of rebates and incentives that are available. Definitely encourage you to check those out and apply for those rebates. We highly encourage you, before you collect quotes, buy anything, please check out those available utility rebates and incentives. There is also a 90-day window to benefit from those rebates and incentives from the date of installation. So if you've already purchased something and it qualifies for that rebate, please apply to that as soon as possible to benefit from those rebates and incentives. But big picture here as well is, as you start to think about projects through the EASSI program and start to think about financing, also think about those rebates and incentives that are available through the utility, so that you can start to get a sense of what projects you want to do, what projects are eligible through the utility rebates and incentives that the utility views as substantial energy efficiency upgrades. Those are also things that, from the city's point of view, we also look at in terms of eligible EASSI projects. Another thing I want to highlight is we had a webinar in early May on utility rebates and incentives. In that webinar, we had an overview of the different types of rebates that are available. We had a representative from Indiana Michigan Power and a representative from NIPSCO, so the electric side and the gas side. And they provided an overview of the different incentives that are available. Basically, these fall into two categories: prescriptive incentives and custom incentives. Prescriptive incentives are sort of your standard rebate application. That there's a set list of products, projects that you can provide an energy efficiency upgrade to your building. And so you would apply through your standard application and receive a rebate from the utility. There's also custom incentives that don't fit into the category of that set list of prescriptive incentives. And so, as the name implies, these are incentives that are more project specific to your building. And so those are sort of the two main categories that are available to you. So definitely check out both those types of incentives that are available. So, if it doesn't fit into that, that set list of prescriptive incentives, your building may also be able to benefit from something like a custom incentive. In addition, this webinar also provided an overview of how to, review your utility bill, what the different line items are. So please definitely check out that webinar. I will also send a recording of that webinar to you after today's presentation. And another thing I would like to also do is tie into how this all fits into the EASSI program in terms of where we are in the EASSI program. So Donna has provided an on-site assessment to everyone in the cohort, and you probably have already received a memo. If not, you will be receiving one shortly. And so we anticipate providing an assessment report towards the end of August, early September. And then we'll give you a week to review that assessment report within your organization and with the key decision makers within your organization. And so around mid-September, we will have a meeting with you to review that assessment report. And so a thing that I also wanted to tie into this is, as we start to think about what projects we want to pursue, how we want to finance them, the available utility rebates and incentives, I think this also kind of, neatly fits into where we are in terms of the phase of the program. That, as you've gotten that memo or will soon receive it, as you start to review that assessment report and start to think about those projects, I think this is also a really great time to think about how do you finance those potential projects? What projects are you thinking about considering? Do these projects qualify for a utility rebate, which is something that, the city also tends to look at in terms of whether that's a significant energy efficiency upgrade that the city would value and find as eligible for the EASSI program in terms of eligible projects. And that also leads into, as you start to pursue those projects and collecting those quotes, sharing those quotes with the city, again, looking at it from the eligibility point of view, that those are projects that are eligible and provide those significant savings to you. And so with that, I will I'll lead into Q&A and then we have a couple announcements at the end. Not seeing any questions so far in the chat, but maybe we can, Sam or Andre, what are like common questions that you kind of get from nonprofits, organizations, that whether it's like some misconceptions, maybe you probably mentioned some of these already, but maybe you can talk a little bit more, elaborate on some things that nonprofits or other community organizations tend to ask you in terms of financing different projects?
One question that I always get, of course, is time. How long does it take? um, and my generalized answer is 60 to 90 days upon receiving a full application. And I always have to put that little bit of a caveat on there as well, because sometimes people may say, well, our first conversation took place in August. But if you don't get me the full application until September, I can't really start the clock until then. So the generalized answer to that is 60 to 90 days from submission of application. I will also say this. We try to make it such that we, as speaking for IFF, we try to make sure that the loan is not lagging because of us. Sometimes we fall a little short of that, but for the most part, when we ask for documentation, or as I mentioned earlier, that checklist of items, the sooner you can get that back to us and the more responsive you can be, that makes us be more responsive as well. And again, we're trying to make sure that we are not the holdup. So when you get it back to us, we're going to turn it around and get it back to you as quickly as we can. But 60 to 90 days is the general answer on the timing.
Yeah, that's a great transition to the one final point kind of I would want to make is, and this is why you should just apply whether you think you're going to need it or not. And then I always joke with like my finance friends when they say like, oh, the loan application is hard. For nonprofits, it is easy. You do this grant writing all day, every day. Like Andre might have made it sound like he's going to ask you for a lot of stuff. He's asking you for half of the stuff that like a grant funder asks you to get a $5,000 grant, right? So for nonprofits applying for financing, I've generally I think is easier than doing loans. But the one thing I wanted to make sure y'all know, and I think it's the place where you should be looking, and it's the example with this program, are things like bridge funding. I didn't know that existed when I worked at La Casa. And so, is knowing like, oh, well, we just did a campaign to raise this much money. Now I got to wait for 3 years for that money to come in to buy that thing I need, versus you can get a loan using those pledges to secure that financing. That also could be if you're doing like something CDBG related, like other grants that you have to spend all the money and then get reimbursed. That's also there's potential ways to finance that. So you don't have to like stress out about how you're going to manage this large grant or these large pledges or long-term donations. You could secure the funding now at a reasonable interest rate. So that way you can write that opportunity cost of waiting a year or 18 months to do the thing that you just raised money for. You could do that thing now. With a fairly low cost of interest. And it might even help you push a few more donors to help give more, to say, hey, could you cover our interest costs on this? And you could generally either step somebody up or get a new donor that's really interested in helping that way. And the last one then, oh yeah, and the last one I might just add, please feel free to reach out to me directly. I know finance for nonprofits, we don't like to talk about it. We don't want to be public. So you might not want to come on here and be like, okay, so we're broke and right. But let me know. I'd love to just talk right confidentially as well about things.
And back to Sam's second to last point there, once you get your project going, if you're not waiting on those pledges to come in, you may even get more, because once a donor sees, oh, the project is moving, the building is being built, or the repairs are being made, or whatever the case may be, that's tangible to them. So then they're able to say, oh, I see this moving, and they may be able to give more funds as well. So sometimes that opportunity cost of waiting can be a little bit more detrimental than going ahead and maybe getting funds up front and being able to continue to do the good works in which you guys do.
All right, thank you, Andre and Sam. Any other questions? Feel free to put in the chat, or you can unmute. All right. Well, I will provide a couple announcements, and then if happy to stay on a little bit later, Andre and Sam, if you're able to as well, to answer any additional questions. Also happy to answer any questions related to EASSI, financing or not. Let me move on to the next slide here. So Sam, as you mentioned, here's our contact information. Feel free to call or email me. This is some contact information from IFF. This is Amandala, which one of the another folks, another person from IFF, and you've already met Donna and Andre, and you can contact Amandala, and then she can connect you to the right person. In addition, there's Sam's email right there, CDFI Friendly South Bend. And yeah, if you're not sure of who to contact, whether that's financing, you can also just email me, and then I can whether shoot that off to Sam or Andre to get you to the right person. Couple feedback questions, if you can put it in the chat. Just give us a little bit of feedback on how you would rate this webinar, good, fair, poor. For poll question number 1, as well as for poll question number 2, if this webinar has met your expectations. So if you could put in the chat, poll 1, good, fair, poor, poll 2, good, fair, poor, we greatly appreciate it. This is something that, this is a new webinar that we've done. And so hopefully we can continue to make, iterations of this webinar that better serves what you're looking for in terms of financing and other EASSI related questions that would allow you to benefit from this program. And while that's happening, have a couple announcements. So we do have an EASSI social coming up next Thursday, August 11th, 6 to 7:30 at the Clubhouse of St. Joseph County. Mark's here. Mark, if you wanted to unmute and give a little give a little background on the social, but essentially an open agenda.
Hi guys, we would love to have you come by. I'm gonna talk about the EASSI program and the way we're gonna get it to work and to see the clubhouse. So hoping you'll stop in. Hopefully see you there. Thanks.
I want to put in a plug that the clubhouse is such a cool little building. You all should really go. It's just feels so comfortable and fun in there. I just absolutely love it. So yeah, definitely go.
Thanks. Yeah, come.
All right, thank you, Mark. Thank you, Donna. Yeah, definitely, it should definitely be a good time. So I hope to see you there. And so check your inbox. I'm going to be sending a couple updates. So of course, I'll be giving a little bit more details on the EASSI social, and just giving some reminders of that. And if you can stop by, whether that's the whole time or just part of it, that would be really cool. And it doesn't have to be limited to the point person that's here through EASSI. It can be anyone within your organization. So feel free to bring any friends or family or other folks within your organization as well. And another thing to look out for in your inbox, I will be emailing you to schedule a meeting to review that assessment report. So as I mentioned, Donna is putting together that assessment report, and she will be sending that to you around late August, early September. And as part of that, we will give you about a week to review it. But in the meantime, we would like to schedule those meetings when we will meet with you to review that report. So please keep a lookout for that so that you can lock in the date and time that's most convenient for you. And finally, I will also be sending a recording and copy of this presentation of this webinar, and as well the webinar utility rebates and incentives. I think that's all I have. We have a few more minutes, and again, I'm also happy to stay on here for 10-15 minutes to answer any questions on EASSI. And so I'll mute myself right here, and feel free to add any questions to the chat or unmute yourself to ask any questions on financing or any EASSI projects, EASSI project related questions. Thank you.
I just want to also follow up that the memos, those of you that have not received a memo yet, will get one by the end of this week. I'm finishing them all up this week.
All right. Mike, any questions? Joe, you have any questions for us? Or Mark?
No, but I'm going to take off on you and hope to see you on the 11th. Thanks.
All right, thank you. All right, well, that concludes our webinar. Thank you again for your time and attention. And you all have a great day. Thank you, Andre. Thank you, Sam. Thank you, Donna.
Thank you, everybody.
Thanks. Bye-bye.